Nobody likes taxes, but everyone loves a tax refund, and they're hitting US bank accounts right now. But this year, the self-proclaimed crypto president has set the stage for what could be the largest tax refund in US history, an influx of cash that many believe could spill over into markets, including crypto. Trump's One Big Beautiful Bill is being credited, or blamed, for turning refund season into something resembling a cash bonanza. In case you weren't aware, Trump's bill changed what a lot of households ultimately owe for 2025, but paychecks didn't automatically adjust fast enough for everyone. So, plenty of people paid too much throughout the year, and that will now be made good by a bigger refund lump sum. That is the core story here. American taxpayers are now due to see a big cash injection thanks to the One Big Beautiful Bill. And depending on which media you're following, this is either a righteous move or a high-stakes push to win voter favour by throwing money at them. The politics of that are one thing. The market impact, though, is another. If you compress a lot of cash landing in people's accounts into just a few weeks, traders will be pretty much forced to treat that as a significant event with implications for markets. So then, what kind of numbers are we looking at here? Well, Treasury Secretary Scott Bessent has gone on record saying that he expects around $100 billion to $150 billion of refunds in the first quarter. Meanwhile, many analysts are projecting a typical refund check this season being close to $4,000. So, the next major question is when this cash actually hits people's bank accounts. Well, refunds don't arrive on one giant payday. According to research from Morgan Stanley, typically 60 to 70% of refunds are received by late March, so the second half of this month is when we should expect to see the biggest impact. In some cases, those who filed their tax returns early may already be seeing their refunds appear. So, in all of this, the crypto angle kind of writes itself. As we pointed out, Trump decided to pitch himself as the crypto president during his presidential campaign. In January this year, he repeated his vow to make America the crypto capital of the world. And now you've got a refund season that's being marketed by the administration in no uncertain terms as some kind of liquidity event. Now, many have been drawing parallels between this wave of tax refunds and the infamous stimulus checks of 2020 and 2021. So, does that mean we're about to get a repeat of that golden bull run? Well, not automatically, but we'll dive deeper into that a little later. First, though, we need an idea of what kind of sums might find their way into the crypto market. So the real question is what happens right after the money lands. A refund can feel like a bonus, but for a lot of households, it's already earmarked for something before it arrives. Rent, car repairs, credit cards, groceries, etc. That's why the idea of a refund wave pumping the markets really depends on the size of the wave. As mentioned, Treasury Secretary Scott Bessent cited a pretty aggressive range, saying the One Big Beautiful Bill could mean roughly $100 billion to $150 billion in refunds. But even if you buy the high-end estimate, it's important to remember that not everyone gets a check, and not everyone will treat it like investable cash. One Bank of America survey found about 32% of respondents don't expect any refund at all. For people who do, meanwhile, 36% said they were planning to pay down debt. Savings came next at about 13%, while roughly 10% said they'd use it for a major purchase or everyday expenses. Other tax season data pretty much backs that up, but with more emphasis on the standard real-life stuff. In one TurboTax survey, 70% of people expecting a refund say they will use it for basic living expenses like rent and bills. More than half said rising living costs are why they rely on refunds, and 21% said they need the money to pay down high-interest debt. Also, 91% said getting the refund as fast as possible matters, evidence of a stretched consumer. And to be honest, there's no shortage of evidence that the consumer is struggling. Just look at debt levels. The New York Fed's household debt data shows total household debt hit $18.8 trillion by the end of 2025, and the same data shows rising stress in record credit card debt and student loans. So, needless to say, many households are struggling and very much in catch-up mode, to put it mildly. So, amidst all of this, why is crypto even part of the conversation? Well, because markets move on the marginal dollar, not the median household. If a small slice of refunds gets aimed at risk assets in the same short window, you'll see that very clearly in the charts. And that's especially true for crypto, where things are generally less liquid compared to traditional markets. So, with that in mind, let's do some back-of-the-envelope maths. Take the $150 billion case. If just 5% ends up finding its way into exchanges and brokerage accounts, that's $7.5 billion. If crypto grabs just a third of that, you're at $2.5 billion. And if you think that's too generous, a 1% crypto allocation across the board still works out to $1.5 billion of demand. The other thing to consider in the year 2026 is that the crypto on-ramp is much easier than it was just a few years ago. For a lot of Americans, buying crypto is now just a matter of hitting that buy button for an ETF sitting next to Apple and the S&P 500. Now, of course, that doesn't guarantee that a ton of capital flows into crypto ETFs, but the point is that there's now an established avenue for demand that we didn't have before. And although the crypto market has been ugly recently, things can turn quickly. Crypto funds pulled in about $1 billion in a single week in the last week of February this year after a 5-week outflow streak. In other words, once buyers decide today's the day, flows can take a sharp turn and you can get a different market outlook almost overnight. Indeed, a spike of positive price action from a rush of tax refund cash could shift sentiment and cause that reflexive rally to the upside. But keeping up with all of these market moves and their implications can be difficult. But that's why you should sign up for the weekly Coin Bureau newsletter. It's absolutely free and you can sign up using the link down in the description. And while you're at it, why not check out the exclusive deals we've secured for viewers of this channel? These include huge sign-up bonuses and trading fee discounts on crypto's leading exchanges, great deals on hardware wallets, and much more too. All that is accessible via this QR code right here, so take a look. Now, as people speculate about how much of this tax refund wave might make its way into crypto, many keep reaching for the COVID-era stimmy check comparison. Why? Well, simply because it's burned into people's memories. People started getting checks and a load of assets went vertical soon after. The brain does what the brain does and connects the dots. But correlation does not prove causation, and if you take a closer look at what households actually did with the money, the picture gets a bit less sensational. The New York Fed ran surveys during the first round of checks in mid-2020, and the averages showed something interesting. Households reported using about 29% for spending, saving about 36%, and using about 35% to pay down debt. Now that's hardly everyone aping into markets. It's more like people using stimulus checks as a lifeline. And remember that there were several rounds of these stimulus checks, and what do you know? This dynamic didn't suddenly change in the later rounds either. When the second $600 checks went out in December 2020, the New York Fed update found the split stayed in the same neighborhood. Roughly a quarter spent, and most of the rest split between saving and debt paydown. By the time the third round hit in March 2021, the behavior was even clearer. The same New York Fed survey found that households planned to spend about 25% of those latest checks, while an average 42% would be saved, with the remainder going to pay down debt. That kind of flies in the face of the narrative that stimmy checks were basically a giant buy order. So, how did we end up with this cultural memory that stimulus checks sent markets to the moon? Well, a massive part of it was the macro backdrop. During the pandemic, traders saw that the US government was willing to step in and do essentially whatever it took to prop up markets, including the issuance of stimulus checks. Once the initial and terrifying sell-off was done with, the ultimate reflexive rally followed. Another part is that even if most people use checks for normal everyday stuff, A small cohort of people being more adventurous with their stimmy checks can still dominate market flows. If you were already the kind of person who wanted to trade, a $1,200 deposit was just the thing to start your trading journey. And both exchanges and brokerages leaned into that fact. Robinhood rolled out cash rewards for new deposits right as $1,400 checks were landing in March 2021. Not exactly subtle. Financial platforms were trying their best to turn a national cash drop into flows in their order books. And this isn't just speculation either. One Harvard and NYU study suggested that stimulus payments helped fuel the infamous meme stock craze. That shows us that a chunk of that money ended up in retail-heavy corners of the market, even if surveys show that it wasn't the main destination for the median household. So, this is where the stimmy pump story gets a bit distorted. The average household used a lot of it to just stabilize their situation. Meanwhile, the market cared about the marginal buyer, all of the reflexive hype thanks to leverage, and the fact that trading had become both popular and frictionless for basically anyone with a phone. Therefore, stimulus checks mattered, just not in the way people usually mean when they say it. The checks didn't turn every American into a trader, although that definitely happened in some cases. No, the checks just created enough synchronized risk-taking for the market to get excited about some relentless upward price action. Now, you might be thinking at this point, cool story, but the evidence you just showed me was for stocks, not crypto. Fair point. But the good news here is we don't have to guess, because there's Fed research that looked at measuring this in crypto markets directly. Back in 2021, economists at the Federal Reserve Bank of Cleveland published a working paper with a pretty simple idea. In that paper, they wanted to investigate the assumption that a bunch of Americans took their stimulus checks and used the money to buy crypto. After all, if that were true, then you'd see something in the data. So, how did they do this? Well, specifically, they looked for a jump in BTC buy orders that clustered around the stimulus amount. And they found it. A statistically significant spike in BTC buys sized at $1,200 right after the first checks went out. They also found the effect was strongest on exchanges that cater more to smaller, non-professional traders. And they didn't see a matching spike on the selling side, which is significant because it supports the idea that this was new demand hitting the market rather than people just shuffling trades. The Cleveland Fed's estimate is that the stimulus program increased Bitcoin USD trading volume by about 3.8% in their window. That's a real bump in activity directly linked to a real-world cash drop. But the estimated price impact they reported was less noteworthy, about 7 basis points or 0.07%. The Fed also estimated that the BTC buying they detected amounted to only about 0.02% of all stimulus dollars. And well, the Fed's results didn't remain confined to an academic PDF. Both mainstream and crypto media covered the study at the time, and both sides of the aisle largely looked at it the same way. There was a measurable effect, but it was a relatively small fraction of the total dollars. At the same time, though, social media was full of people flexing that they flipped their stimmy into Bitcoin. And what's more, mainstream media outlets even ran with the phrase Bitcoin stimmy trade as a headline, which tells you how mainstream the meme got. And that's the crucial thing. Once that meme exists, it can drive momentum beyond that initial burst in trading volume. Just because the Fed couldn't forensically link stimulus checks to crypto pumps doesn't mean the stimulus checks didn't help create the risk-on environment that drove one of the wildest crypto bull runs ever. There's even research out of Harvard using consumer transaction data that found stimulus payments can relax people's budget constraints and increase crypto buying specifically. That lines up with the same basic idea. When people get a sudden cash cushion, some of them take more risk. So, if you think cash injections have zero relationship with crypto buying, well, the evidence disagrees. And if you think they were the major reason for the 2021 bull run mania, the same evidence also disagrees. But again, we'll stress the point that price only needs a marginal buyer to go up. So, the ultimate question is, what happens this time around? Well, let's look at some possible scenarios. Now, of course, this isn't the full menu of possible outcomes, just some of the scenarios that make the most sense if this tax refund wave really does prove to be the largest of all time. One bullish path is that which most of us in crypto probably hope for: people getting big tax refunds, seeing that they've got extra cash and deciding to buy some crypto with it. A cohort of people see that refund hit and decide to go risk on. Again, this doesn't need to be the majority. If just a small cohort buys BTC, ETH, and whatever's trending in the same couple of weeks, the price impact can punch above its weight because it's synchronized. This is all the more true for lower liquidity altcoins. Another different but bullish path is the brokerage route. In 2026, a lot of crypto buying is just someone buying a spot Bitcoin ETF in the same app they use for stocks. So the refund money doesn't have to touch an exchange to support crypto prices. Instead, it can manifest as ETF inflows and force market makers to source coins. Another way that this could play out is a pure narrative trade. If enough traders believe refunds will pump crypto, then they'll try to front-run that pump. Add leverage and liquidations, and you get some wild moves that get rationalized after the fact, even if the original spark was pretty small. And sometimes that's all it takes to shift sentiment and momentum. But it's also important to map out some possible bearish scenarios. This isn't the same environment as 2021. Retail is less enthusiastic about crypto in general. The speculative retail energy that used to cluster in crypto has been drifting into other assets instead. And when major crypto exchanges are showing retail trading slowdown, that's not exactly a sign of surging hype that's ready to gain more momentum. In their last earnings report, Coinbase revealed that consumer transaction revenue had dropped sharply. However, it's also important to remember that a few green candles can turn this around quickly. But sticking with the bearish scenarios for just a moment longer, there's also the overlooked fact that tax season isn't just about refunds. People also owe taxes, and that can create the opposite flow, selling a little of whatever they own to cover the bill. Historically, early April has been rougher for markets, partly because taxpayers raise cash to meet their tax obligations. Then there's the not-so-small matter of geopolitical unrest. The Iran war kicked off right as refund season got going. The initial disruption has already pushed up energy prices and could trigger a more significant inflation spike if the conflict drags on. And knock-on supply chain issues beyond oil, including everything from food to pharmaceuticals, semiconductors, and fertilizers, can turn into real shortages and thus higher prices. So, despite what the past has shown us about cash injections, two similar cash drops can produce two totally different results. All right, folks, that's about all we have time for today. But what do you think? Will these tax refund checks result in a pump? Or is that just wishful thinking? Let us know your thoughts down in the comments. And if you want to learn more about how retail speculative buying today compares to the 2021 bull run, then you should check out this video right over here. That's all from me for today, though. So, as always, thank you for watching, and I'll see you in the next one. This is Guy, signing off.